Welcome to MacroHive Conversations with Bilal, Hafeez. MacroHive helps educate investors and provide investment insights for all markets, from crypto to equities to bonds. For our latest views, visit macrohive.com.
Hi, Bilal. Welcome to the podcast. Obviously, you're very familiar with the format. Hopefully, it's interesting being on the other side.
Yeah, it'll be my first time, I think, being on the other side. So
Oh, no,
it
excellent.
should be
Well,
fun.
hopefully, I do your usual high quality interviewing justice. I suppose obviously no need to introduce yourself for our listeners. But thought today there's quite a few as we get towards the end of the year, quite a few sort of interesting topics we can kind of run through, particularly year in the review, what our sort of thoughts are for next year, some of the recent pieces we put out across our researchers on some of the kind of really sort of weird and wonderful things that could happen next year, and then a little bit more about some of the sort of technological side that obviously you're very sort of in depth and have been doing a lot of work on, and then just a little bit more around sort of the interesting books and films that you've sort of seen this year. So does that sound good?
Yeah, sounds great. Yeah, look forward to it.
Excellent. So, I mean, I suppose to kick off, 2023 obviously been a very, very interesting year in markets, especially with macro and the themes that kind of played out. Really seen quite a few sort of strong momentum moves across markets and then quick reversals. So how about we just sort of start off with kind of the main sort of takeaways you've had for the year within the markets at this time?
Yeah, sure. I mean, the first thing I would say is that if you just look at the change in different market prices from the starts of 2023 to the end of 2023, it's quite remarkable that bond yields are essentially unchanged over the year. Now, of course, there was a big round trip along the way, so bond yields shot up and then came back down recently. But over a 12-month period, they're pretty much unchanged, as is the dollar. Euro dollar is roughly unchanged on the year as well. Now, the yen is much weaker, but in general, the big currency euro dollar is unchanged. The big winner, though, has been equities. Equities, like US equities, are up, I think must be something like 20%, year to date. So the biggest winner has been equities, so for all the focus on the Fed, inflation, interest rates, this, that, and the other, we've ended up having a really, really good equities year overall. And I think what this reveals to us is the biggest surprise of 2023 was growth. And in particular, US growth was way, way stronger than consensus and the market was expecting. Now, thankfully, the MacroHive team led by Dominique, did have a view early on that we would not see a US recession and US growth would be way, way stronger than everyone thought. So thankfully, we were on the right side of that. But at the start of this year, the consensus view on US growth was that it would fall to around 0.3% this year as a whole, and there would be a recession this year. So people were trying to argue, is it the recession in the second half of 2023 or the first half? That was the debate. As it turns out, growth has ended up being closer to 2.5% this year, which is actually higher than the previous year, than last year. So growth has been really the big surprise this year. Inflation has turned out to be roughly in line with what people were thinking. So inflation has sort of generally fallen over the course of this year. It's around 3.5%. We're ending the year around 3.5%. So still above the 2% target, but it has generally fallen. And that was in line with what most people were expecting. But so the big shock has really been US growth.
Absolutely. And yeah, I think it's very, obviously we'll come on to the sort of 2024 outlook in a little bit more detail shortly, because I think that's really strong growth story does feed very closely into that. You mentioned JPY being a bit different in terms of sort of being quite far from where it was at the start of the year, at least. How do you sort of see the recent change in, I guess, where the BOJ's ended up versus where the sort of Fed and ECB have in terms of kind of the trajectory of some of them coming more?
Yeah, I think Japan's been an amazing story this year. And the one thing I would say is that in general, for the last, say, 10 to 15 years, Japan has, more and more become a sideshow in global markets and global macro. So increasingly people, like we sort of focus on US and China as the two engines of the world. And then you look at Europe, and Japan has become less and less significant for all investors. So it's actually good to see Japan coming back to life as a focus for markets. And of course, it all started this time last year, so in December 2022, when the BOJ adjusted its yield curve controls. So that, in some ways, was the beginning of its tightening process. So So over the course of this year, we've steadily seen them lift the YCC controls almost completely. I mean, they kind of have a soft upper limit, but they've effectively let go of the yield curve control. So that's a form of tightening. That has led to higher JGB yields, where so that's an interesting trend. But what's interesting, I find, is that when they lifted the upper bound, or they did a soft lift of it, JGB yields didn't shoot up, above 1%, which was their previous target. Like sometimes you think in markets, it especially gets pegged, that when you lift the peg, it should shoot up and go crazy, but it didn't. And that tells you something about how the BOJ engineers changes, where they kind of give something to the market, see the volatility, step back, control things, and are really quite adept at making sure things don't go out of control. So I think that's one sort of general observation about the BOJ. In terms of the currency weakness, I think a lot of it was earlier on this year, where we did see US bond yields rise up to almost 5% up until Q3 this year. And that, in general, is very negative for the yen, and the yen really suffered in that environment. So dollar yen shot up. And all the BOJ changes weren't really enough to cause too much of a switch in that. But over the past few months, that's changed. And what has changed is obviously there's been a Fed pivot. The Fed's become a way more dovish, and bond yields have fallen in the US. And at the same time now, the BOJ has started to indicate that they may move out of negative short-term interest rates, which has helped the yen strengthen a bit. Although in their December BOJ meeting, they've started again, like what they did with YCC, they've started to say, hang on, we may not do it as quick as you think. So again, it's the BOJ playbook of, exiting from extreme policies, but doing it in a way which won't lead to crazy interest rate moves.
Absolutely. And definitely central banks has been they've been important post-COVID and post the sort of inflation crisis. But the sort of sudden shift, as you say, in terms of across Fed and feeding into the ECB and a lot of the others, more easing, particularly post in November, particularly, has been quite sort of remarkable. One of the sort of quite interesting things in markets is that the correlation between sort of particularly just equities and bonds has been very strongly positive since that through that sort of rally from November, which is kind of a very big sort of central bank effect. Do you see that as being, I suppose, how do you see that kind of fitting in with the kind of the year's moves, and do you see that kind of correlation remaining ahead? And is that what kind of, I suppose, implications does that have for the sort of diversification factor of kind of what you typically think of bonds versus equities?
Yeah. I mean, in general, what investors or asset allocators would want is that when equities do well, they don't mind if bonds underperform. So equities up, bond yields up, bond returns down, and that's fine. So because your equities will give you your returns. And in return for that, what they want is when equities underperform, what you want is you want bonds to rally and do really, really well. So you want bond yields to fall. Now that correlation has kind of switched around over the past year or two, mainly because of inflation. So such that when we've had inflation shocks or term premium shocks over the past year or two, then what's happened is bonds have sold off, but so have equities as well. And so what you need is less inflation shocks. You need bond yields to fall, and then that's when equities go up. So basically, both asset classes, move up and down in the same way. So the correlation is positive from a returns perspective. Now, that's not ideal from an asset allocation perspective, and that's the big challenge for all investors around the world. Is how do you diversify your portfolio then? Because what's your defensive asset? Is it gold? Maybe that's too small a market. Is it other commodities? Is it crypto? What is it? And I think that's the big challenge that they'll face. Now, from a kind of a theoretical perspective, if the correlation does continue to be like this, then what should happen, and we've written papers on this over the course of this year, is that term premia in interest rate market should go up. So term premia essentially is that bit of the interest that is over and above expectations of changes of interest rates linked to central bank policy. So if the Fed is expected to move interest rates up or down over the next 10 years. That determines the bond yield, but there's a term premium on top of that, which is the extra bit that bond yields need to offer to attract investors. And one driver of that term premium is this correlation. If bonds don't offer diversification benefits, then that term premium has to go up because then there has to be something else that will attract investors to those bonds, which is this extra yield. So my contention would be that if this correlation holds, as it has over the past year, which I think it probably will continue to be the case in the next year, then term premium in general should go up because bonds aren't offering that diversification benefit. And this has actually been the norm, pretty much in the 90s, 80s, 70s, term premium was positive. You always had term premium in the bond, in the yield curve. So I think that's one factor that in the background will be pushing bond yields higher, outside of the ups and downs of central bank policy.
Oh, thanks for that. No, that's a very comprehensive. And we will, as I say, get onto the sort of 2024 outlook shortly. I was also just going to sort of add, I mean, clearly it's been a big year for markets. It's also been quite a big year for sort of macro Hive as well as a firm. Do you want to just sort of run us through some of the sort of developments there?
Yeah, I mean, I think for me the key thing is markets are always changing, and then we kind of have to be well positioned to adapt to all of the changes. So one of the things we found over the course of this year has been how important oil markets are. So if you're kind of in the investment community, if you look at markets all the time, you tend to have your kind of core focus, FX, rates, equities, and kind of oil is kind of, it kind of bumbles along in the background. But I think oil's been super, super important to everything. It's been one of the biggest reasons why inflation has fallen around the world this year so sharply. And oil prices are down, 5 to 10% this year. Gas prices are down like 50%, which has helped Europe. So having a view on oil has been super, super important. So this year we added someone in our team, Varesh, in Abu Dhabi, who covers oil, and he's been a fantastic addition to the team. And that really helped us understand some of the dynamics in oil markets, which only a specialist would know. Previously our bias was to be quite bullish on oil. With more analysis, we realized actually that wasn't necessarily the right view to have. So we adjusted our view accordingly. And actually, we have a model portfolio, sort of theoretical portfolio, which we run, which captures all of our trading views. And some of our best trades this year have been around trading the ups and downs in oil. And our portfolio is up around 10% this year. It's been a great year for us from a portfolio perspective. And it's been helped by this oil perspective. The other things we've also done is we've added someone in Shanghai to look at China, because I think China is super interesting where, to some extent, China kind of sets the trend for non-US everything. If China's doing well, then Europe, has an impact in Europe. And, we recently hired Liang Deng, who was a podcast guest recently, who's helped us analyze China, understand it way, way better, and on the ground, objective, neutral, in terms of his biases, which is really good. Because often I find with China economists, they either tend to be follow the kind of a very optimistic government line, or they tend to be uber bears. Liang is kind of plays it straight down the line, looks at the data, and lets the data kind of lead to his views. And one of his biggest findings, which I think is very important, is that there's a mismatch between supply and demand in China, where the supply numbers, like industrial production and such, are looking relatively healthy, but the demand numbers are very weak. So that China is really struggling to generate demand. And in the end, you need demand to meet that supply. Otherwise, you just end up with an inventory buildup in an economy and oversupply. But essentially, there's a supply-demand problem in China. And that's one of the reasons why inflation is so low in China. And that's one of the reasons why China is exporting goods deflation to the rest of the world. And so understanding that whole nexus has been really, really important for us. So anyway, those are two additions to the team that we've had. We can talk more about AI and some of the modeling work perhaps a bit later, but that's also something else that's been really exciting this year.
Absolutely. No, thanks very much for that. So I suppose on the topic of kind of outlooks and our calls, 2024 is obviously around the corner. As you mentioned, Dom had a great call in terms of GDP growth and sort of US strength really sort of sticking around much longer than the market expected. We're now looking into 2024 where it seems like the market's a bit split in terms of will there be a recession or not, or just a soft landing. But it's now much more mild recession kind of being thought about. And we've now shifted much more towards Fed cutting, and how fast they'll ease is really the sort of the question into sort of a presidential election year. Um, could you just sort of give us a quick rundown of sort of the main kind of things that you expect to sort of pan out, and where they sort of differ from potentially the broader sort of street, I suppose?
Yeah, sure. I think what helps set the scene for 2024 is to understand why growth was so strong in the US in this year in 2023. And I think there's a few things that were occurred this year which not many people anticipated, which really helped growth. Number one was that on the supply side, labor supply in the US has really picked up, mainly driven by foreign-born workers. So immigration has helped a lot on the US labor supply side, and that's helped the supply side of the economy. And if you look back, almost like 80% or so of the increase in the labor supply of the last few years has come from foreign-born workers. And so that's something that's continued into 2023, and that's really helped the growth picture overall. So that's been one factor. Another factor that surprised everybody was been the strength of auto demand. So even though interest rates were relatively high over the course of 2023, people still bought cars. Now, why was that? It was because people had not bought new cars in a while because of supply chain issues in earlier years. So there was a build-up of demand to buy new cars, even though financing those purchases was harder than before. So there was a sudden kind of burst of demand to buy cars. And then perhaps the biggest surprise has been on the property investment side, where, again, despite high interest rates, there's been a big pickup in non-residential structures investment in the US over the course of 2023. Most people thought that because of high interest rates, that there wouldn't be so much investment in structures and buildings. And they also thought that because of the retail apocalypse, or whatever you call it, shopping malls, nobody goes to shopping malls, that would also lead to a collapse in that source of demand. But instead, because of the various stimulus programs that the Biden administration introduced, there's been a surge of factory building in the US that has really helped kind of that source of demand. And then on the other side, I think people kind of over-egged the risks around the regional bank crisis that the US had. So people tried to kind of extrapolate that to be another global financial crisis, but instead it kind of petered out to be a nothing. So these are some of the things that happened in the background. But I would say that to some extent, what helped growth a lot in 2023 was that all the supply side forces that worked against growth in 2022 and in the immediate years after COVID flipped the other way, where you had a negative supply shock in 2022. And this year, 2023, you had a positive supply shock, which basically means, if you remember from supply demand curves at high school, if you have a positive supply shock, that means growth goes up and prices go down. And that's exactly what we saw this year. Now, next year, I don't think it will be as fortuitous in that sense, because this was kind of a readjustment year. So I think the possibility of having this kind of perfect mix of falling inflation and kind of falling growth but not recession, I think that's too unlikely. And so when I look at the year ahead, I mean, I don't like to make a big call for the year ahead, and this year is a good lesson in that. I think I prefer to think about risks. So if you look at what consensus is looking at for 2024, it's essentially saying that in the developed world, inflation will continue to fall, and it will fall down towards 2.5%. So we'll get to a comfortably into the 2% handle, so inflation won't be a problem. And it's also saying that growth will generally fall, but we won't necessarily have a recession. So it's kind of a soft landing, and there'll be lots of central bank cuts in order to make sure that we don't go into recession. So for me, the risk is that we either do have a recession, in which case the Fed and other central banks cut way, way, way more than what the market is pricing. So the market is pricing around 6 cuts for next year, and then I think about 4 cuts the year after. But if we do have a recession, then the market would have to sort of price cumulatively way more cuts. Or we end up with an inflation problem, which would happen by the Fed prematurely cutting rates thinking that they don't have an inflation problem, then an inflation problem reemerges later on. So I think we're going to end up in either one of these different sort of dynamics. My bias is probably to try to play for very strong growth early on next year. So kind of a continuation of the second half of this year, and then inflation scare to occur in the second half of next year, which will cause central banks to suddenly have to sort of pivot. And the basis for that view on the inflation side is that a lot of the improvement in inflation we've seen over the past couple of years has been driven by falling energy prices, falling goods prices. Now, I think a lot of those improvements are not going to continue because we've seen big drops in those already. And then if you look at the services side, whether it's like medical care services or housing costs, I think they're relatively sticky. And I think this financial conditions easing that we've seen this year in the latter part of 2023 will end up causing like housing costs to not fall by as much as people think. So my bias would be to kind of play for sort of strong growth early on, kind of almost like the Fed's trying to overstimulate growth, but then that later to cause a problem, probably in inflation. So that's kind of the playbook I'm trying to go for next year.
I think so. That's very interesting, and obviously you sort of touched on a lot of topics there in terms of especially the sort of recent drivers of deflation, some of which look a little bit less. I mean, the goods side, for instance, all the sort of geopolitics in on that front. One of the big questions for next year, and obviously it'll be late on in next year, is the US election. Do you see one, I suppose, that kind of adding to your sort of conviction? You don't need to make a call on what the outcome will be.
Yeah, I think this is a massive election, because to some extent, because Trump's still in the race in some form or another, this is a race between the establishment and the non-establishment, which is Trump. And I think what we saw in the last presidential election was the whole establishment, every part of the establishment, came together to prevent Trump from getting reelected in different ways. So I think something similar is happening now, and I think the Fed is trying to ensure that the economy is perfectly set up for the establishment to win the election in some way, to kind of say it politely. So that means they're going to really try to juice up growth as much as possible to to really help the administration, to help Biden win the election. I also think that what kind of this is kind of a side point, but we also have to remember that the Treasury Secretary of the US at the moment is Janet Yellen, who is the previous governor of the Fed, who's very influential, and she has a big influence on Powell at the Fed as well. So I think there's kind of a political element there. So I think on that side, there's going to be a big influence. So that really kind of maybe not completely explains the recent Fed pivot, but I think partially does, in the sense that it's all about growth to help boost Biden's chances of winning, or should I say, preventing Trump from winning. On the other side, though, what could be tricky is that if immigration turns out to be a big political issue, and the border and all of these sorts of things, then the US, Biden, may actually start to cut back on the ability of foreign workers to come into the US. So they've had a free run to come into the country over the last few years. That's really helped the economy. But maybe because it's a big political issue, the labor supply story could start to work against the US next year. So that adds to some kind of inflationary pressures. So together, if you take both together, you kind of have this interesting kind of sort of inflationary dynamic that starts to kind of kick off, because you have a dovish Fed and you have a labor supply problem, which kind of will build up an inflation problem later on. So kind of that's the way I'm thinking about the election.
Oh, that's really helpful, and sort of I suppose reaffirms the fact that politics and geopolitics will remain very, very important for economies and markets. On that front, I know we do put out a sort of annually grey swan analysis, which some of our listeners may not sort of be completely familiar with the sort of term. Could you sort of give us a brief kind of overview of what exactly grey swan analysis is, and some of the kind of views that I suppose some of our sort of contributors have put forward this year?
Yeah. I mean, this is one of our most popular publications that we have, and perhaps the most fun publication that we produce. But in essence, this is inspired by Nassim Taleb's Black Swans. So black swans are completely unexpected events that occur, which are really high impact. Some people kind of said maybe the global financial crisis was a black swan, although other people argue that it was kind of predictable. But it's these kind of extreme shock events. So we try to list our own black swans for the next year, but by the very fact of us listing those black swans makes them not black swans, because suddenly we're influential in the market. We're saying these are possibilities. So suddenly this becomes a known unknown, kind of, so to speak. So we call it gray swans. So it's kind of a lighter version of a black swan. So every year we come up with something. A year ago, actually, I should say, these are gray swans are things that we don't think will happen next year, but we think there's a risk they could happen. So these are kind of more like tail events for next year. So it's kind of allows us to use our creative juices to kind of think about scenarios which are outside of the normal up and down of markets that we're so used to doing. And I was looking back at what we said a year ago, and we had many misses, but one thing we did call correctly was we said there would be a banking crisis in the US. Dominique actually wrote that as her gray swan, and that obviously did turn out to be the case. So that was one gray swan that did turn out to occur. So this time round, we have a whole bunch of gray swans, a whole range of them. We have one fun one written by Carl Massey is about AGI, how there could be some kind of artificial intelligence trading system that's already active in the market, and that is slowly takes over the market in 2024. That's one. There's three I wanted to highlight. One that I wrote, which is about the EU. There's another about OPEC, and then there's another about Turkey. So maybe I could, with your permission, Henry, if maybe I can run through those.
Absolutely, please do.
Yeah, so my one was entitled like Climate Breaks the EU. And so this is a European Union or Euro breakup scenario in 2024. Now, of course, we've had lots of events that could have led to the breakup of Europe, which didn't. So we had the sovereign crisis in 2011, 2012, Europe didn't break up. We had the migration crisis in 2015, Europe didn't break up. But I think there is a risk here. There could be another event, which is European climate policy. And so just to be kind of clear here, that Europe is at the forefront of implementing climate change policies, one of which is related to transport, which I think is very close to the heart of most people in Europe, in particular cars. So essentially, Europe has introduced all sorts of rules that are making it much harder to buy regular fossil fuel cars, petrol, diesel cars, and making it much easier to buy electric cars. Now, the problem with that is that for a lot of people, electric cars are expensive, so they just literally can't afford it. For many people, electric cars are not convenient. They can't get charging points. And then for many people, they're impractical. The range on those cars are not great. And so forcing people to switch to a mode of transport that they're not comfortable with, I think is a big political issue within Europe. And interestingly, in general, the main parties that are against climate change policies are the far-right parties. So, for example, in Netherlands, Geert Wilders recently won the most seats in parliament there. Now, he has all the usual far-right policies, anti-immigration, in this case, anti-Muslim, anti-EU, all of those sorts of things, which you would expect from a far-right party. But he also has an anti-climate change set of policies as well. So he's much more kind of pro, fossil fuel cars, pro, mining and drilling for oil and all of those sorts of things. And so there's an interesting situation in Europe where it's the far right parties that have kind of pro traditional car policies. And so the risk, I think, within Europe is that for people, even if they don't care about immigration, if they do care about transport and cars, the only options they have to vote for are far-right parties. And in May 2024, we have European elections. And there could be a risk here where if the far-right parties lean on this anti-climate change, choice around cars, they could end up, doing really, really well. And so suddenly you have a whole bunch of far-right parties within the European Union who could break up the European Union from inside, basically start to sort of break up the institutions from within. So anyway, so I laid up a scenario around that as a potential gray swan for next year. So that's one. The second gray swan I wanted to mention was around OPEC, and this is Varesh, our oil analyst in Abu Dhabi. He wrote this, that there's a risk a gray swan event could be OPEC breaks up. And the rationale there is actually under the hood, there's a lot of tension within OPEC. So, for example, the African countries that are members of OPEC are unhappy about the quotas that they have to follow to produce oil. They want to produce more, and quotas are for them to produce less. Russia, who's a member of OPEC, they're doing whatever they want, so there's no real agreement there. And then you actually do have some disagreements between Saudi and UAE on a number of different areas around politics. So all of this could come together, and then OPEC just breaks up, and and Saudi goes on one side, and then all the other countries do whatever they want. So that's another scenario for next year. And then the final gray swan, written by guest writer John Floyd, very experienced trader and portfolio manager. He wrote how Turkey could come back as a big positive trade for 2024. And over the past few years, Turkey's become more and more marginalized as policymakers have followed lots of heterodox policies, but actually Turkey has suddenly become a bit more orthodox in terms of policies. Currency is super undervalued, and the credit numbers are starting to improve. So 2024 could turn out to be the return of Turkey back to EM, could end up being one of the sort of the best performing markets.
Thanks very much for that. That's really, I would sort of encourage all our listeners to kind of check out the rest of them as well. I think one of the interesting things actually about especially the EU and the OPEC ones, is actually, whilst they are quite tail risk events, there is an argument to say sort of the current situation is almost the unsustainable part in terms of sort of OPEC having their caps, which very much discourage kind of investment in extra sort of drilling and extra sort of getting out stuff. And Europe is everyone's kind of questioning how can its industry and stuff survive with the transition, and how can especially with shifting away from cars. So certainly I think it's definitely likely to be movement on those fronts, even if necessarily the actual outcomes are sort of the big cataclysmic ones that kind of our gray swans note. So we'll definitely sort of see there's lots of value in kind of checking those out for sure. You did mention the gray swan by Carl Massey around AI. I know that was very much a sort of very almost science fiction, very out there, but very interesting kind of analysis. But you've been doing a lot of work, and I know sort of within Macro Hive there's been a lot of work done on the AI side this year. Would you be able to give us a sort of brief overview of the main things that kind of are the most sort of exciting that you've sort of seen this year, and where you kind of see them headed out in the future?
Yeah, sure. I mean, we've been doing a ton of work on AI, and it's funny when people look at Macro Hive, look at us, they don't think of us as an AI company. But I would say we're at the forefront of AI, and in fact, a part of our output is AI driven, and the fact that people don't realize it's AI tells you how good the AI output is. That it's so kind of human looking that people don't realize that. So I think AI is huge. Obviously, it's caught the attention of markets. One general question is it a fad like crypto? Where the market gets besotted by it and then it sort of fizzles out. I do think AI is real. It's essentially a real technological shift that we've seen. So from a kind of a historical perspective, the way I would think about this is that machine learning, so this is using kind of computer science type techniques to work with big data to make predictions, really kind of came into the fore 2010, 2011, 2012, and got adopted, especially in the financial sector by high frequency trading type organizations. And so that was one big step change. And then outside of finance, in image recognition, it became really, really quite powerful. Now, the other big step change, is the launch of large language models, popularized by OpenAI's ChatGPT, which got released just over a year and a half ago. And that's another step change as well. And the beauty of that is that it's what we call generative AI. So, traditional machine learning, what that does is it looks at whole like millions of different data points and gives you kind of a single answer. Is that cat? Is that not cat? Buy or sell? Whereas generative AI runs the process the other way around. You give it a simple question, write me a poem about something, and it will come out with loads of data points. It will come out with something that looks very intelligible. So it's kind of running the process the other way around. And I think it's very sort of powerful. And it's got almost kind of magical like properties in terms of like, wow, how can it write all of these sorts of things? But I think it's very powerful. Now, I think the mistake many companies that are using AI are making is, and especially companies that present themselves as AI, is that I think they're confusing features for products. And I think there's a misunderstanding of how to apply AI in financial markets. So when I talk about features versus products, if you look at Twitter, every day somebody is saying, look at this cool new thing I built using ChatGPT or LLMs. And this is a new tool that you should pay for and buy. And this is a company I'm going to launch. The problem with that type of approach is if you're able to do that so quickly, other people can replicate that very quickly. But more than that, OpenAI can just introduce that as a feature into ChatGPT. So we've already seen that. So for example, a whole load of companies started to say, okay, we're going to launch a company where you can use ChatGPT on PDFs. And so that's our big sort of play, is something like that. Then what ChatGPT did was they said, okay, that's a feature now of ChatGPT. So ChatGPT 4, it can read PDF files now. And so within MacroHive, we use that all the time. So for example, there was a Bank of Japan meeting recently. And what I did was I downloaded the PDF of the Bank of Japan latest statement, and the statement from the previous meeting. I uploaded that into ChatGPT 4 and said, compare the two and tell me the differences in the sentences between the two. And it came up with the differences of the sentences. Then there's Gemini, which is Google's version, previously called Bard, which is multimodal, which allows you to, it can interpret charts, for example. So there's all of these things that the LLM companies are doing for you that you don't need to build yourself. So I think there's an issue around, what should you just outsource almost to what the LLMs can do, and what's the advantage you can do as a financial company? And I think the mistake a lot of people are doing on the AI side is they're spending huge amounts of resources trying to either use new training data sets, or they're trying to build new features, which will either be redundant very soon, or these LLM companies will build themselves. So that's one kind of challenge. And then the other challenge in the finance context is that financial markets have a peculiar issue of it has very high noise to signal ratio, which makes everything very unstable, and everything's non-stationary as well. So to give an example of what I mean by this is AI kind of works very well for things that are sort of similar over time. So for example, can it recognize a cat or not? A cat is a cat is a cat. Cat today is the same as a cat 10 years ago is the same as a cat a year before. So if the AI works out the way to recognize a cat, it'll kind of work quite well out sample going forward. In the same way as with LLMs as well, if your LLM is trained on a data set up until 2023, when you ask it a finance question, it will be able to give you an answer on things that kind of worked up until 2023, but it will be very weak on telling you something that requires much more up-to-date knowledge and much more nuance as well. And it may not necessarily follow that even if you do find that LLM knowledge from the data set today, that will necessarily hold for the future, because markets incorporate new information very quickly. So what works today doesn't necessarily work tomorrow. So the challenge in using all of this AI, whether it's LLMs or machine learning, traditional machine learning, is that you have to, in financial markets, have couple that with deep domain expertise. So what we've done is that we have our domain experts, like our research team, who really understand the nuance of markets, the nuance of data, and you basically combine them into the AI process. And if you do that together, so you combine natural and artificial intelligence together, you end up with a super product by the end of it all. And because of this instability in financial markets, you have to constantly retrain all your models. And one of the inputs for that retraining are the expertise of these domain experts. So you can't just rely on computer scientists. You have to also have domain experts who understand the data and the relationships. So there's an important marriage between the two that's very, very important. So this is the work we've been doing over the past year. Some of the output you can see. The end result will be, I'll give you two examples of two things that you'll end up seeing. One is that we've got some very clever regime detection models or frameworks which can be customized to each client's portfolio. So a client could say, okay, this is the way I trade, and we come up with a very personalized regime detection model to say, the regime that you're trading will do well in is active today, or today the regime detection model is saying, actually, today is not your day, so you should probably lever down your style. That's one thing. And the other one, which uses a lot more of the language side, the LLM side, natural language processing side, and the domain expertise, is using all of this to come up with hyper-personalized filtering and relevance for each individual investor. So if an investor, for example, just focuses on short-term interest rates in the Eurozone, we can kind of use our domain expertise, our understanding of the client, our LLM technology to come up with something that's ultra precise and relevant to them, delivered to them in the right way at the right time. So these are, the way I think this is going to pan out as time goes on, where you have LLM providers like OpenAI, Google, and so on, as providing the foundational AI layers. But then on top of that, you have deep domain experts like Hive, who basically come up with a hyper sort of refined set of outputs for the financial sector, which is our area of specialty.
That's really exciting stuff. I don't know, from our perspective, certainly, I mean, in financial markets, one of the biggest kind of questions is the model worked until something changed. What to do after the model stops working, kind of thing. So that's really exciting, and I would again encourage everyone to sort of stay up to date, remain up to date on all our sort of developments on that front. So now, just to sort of I suppose finish off, I know you like to sort of run a lot of your podcast guests through kind of books that inspired them, or sort of that kind of slightly more sort of cultural aspect. I suppose to throw it back at you and to be a little bit more sort of focused, what are the kind of sort of are there any sort of books and films and theatre or any other cultural sort of things that have kind of stood out to you this year, or that you'd sort of recommend for our sort of listeners?
Yeah, sure. Yeah, let me start with books. I mean, I tend to read a lot and watch a lot of TV and films and stuff, so I'm a bit of a kind of a culture nerd, so to speak. So a really good book on artificial intelligence is a book called Artificial Intelligence, A Guide for Thinking Humans by Melanie Mitchell. It's probably the best book I've read on AI for a generalist audience. So what she does really well in there, she provides some of the history of AI, and she helps explain some of the technical aspects of AI in a way that you don't need to be too technically aware yourself. So that's an excellent book, which I'd recommend. And a few other books. Another kind of nonfiction book was, this is on the culture side now, is a book called Cinema Speculation by Quentin Tarantino, the film director. It's his first book that he's written, where he talks about, by chapter, different pairs of movies from the 70s and maybe the 80s, and he kind of talks about why they worked and why they didn't work. So he did it really well and talks about the presence of actors. He's a great writer as well, very kind of funny. So that's a great book if you're a film person. Again, on the kind of on kind of that sort of line, there's another book I kind of reread, which is an older book, came out I think in the 50s, a book called The Wisdom of Idiots by Idris Shah. So Idris Shah's he's kind of a spiritual guy, he's a Sufi sort of by background, but he has a collection of stories which are kind of parables almost, morality stories, but they're really funny. And often the central character of each story is an idiot or seeming sort of idiot or fool, which ends up revealing kind of the hypocrisy of somebody or the fault of somebody else. So it's a really fun read. It's very humbling when you read it, and it's sort of short chapters. It's really funny to read. And then two kind of straight fiction books I read, which I thought were really inventive and clever. One book was called The Red Scholar's Wake by Boddard, which is a sci-fi book, and it's about it's kind of like a thriller type book, but the central relationship in the book is between a woman and a spaceship that's sentient. There's a love relationship between a spaceship and a human. So I thought that's such a clever conceit to have that in the book, and it's like a page turner. So it's really, really good. The other book I'm just almost finishing right now is a book called People Collide by Isla McElroy, and this is a body swap story. So if you've seen films like Freaky Friday, where like mother-daughter swap bodies, or Big, where you become young or old, things like that. Now this is about husband-wife swap bodies. It's such a clever idea. So suddenly all the kind of the marital tensions that you have come out through the other person inhabiting the other person's body. And it's really clever, and it really gives you an insight into how a woman would see the world differently if they inhabited a male body. Suddenly the world is actually more easier for them to access. And then if a man inhabits a woman's body, in this case the wife's body, suddenly they realize actually there's a lot of difference in how people interact with you. Like not least if you talk to somebody, guys often think you're like interested in them romantically when you're not. You just want to talk to them. So it's a fantastic book. So those are 5 books I'd recommend. They all came out this year, apart from the Wisdom of Idiots.
Oh, thanks for that. And in terms of film and TV?
Yeah, film and TV. So on the film side, I thought both Barbie and Oppenheimer were fantastic movies. In some ways, I actually watched both of them on the day of release. So I watched Oppenheimer and Barbie same day, and they're good for different reasons. Barbie was just a fun movie, great songs, but deeply feminist as well. And again, gave you a perspective on what the world would be like if it was female-centric rather than male-centric. Then Oppenheimer was kind of the other way, almost very masculine movie, technically excellently done. But for me, what was interesting about Oppenheimer was what we were watching was a bunch of people building a weapon of mass destruction. That's what we were doing, and you don't quite feel that when you're watching the movie. But in reality, what this is showing you is that often the most violent creations ever are done by men in suits in sterile rooms. So when we think about violence, we often think about crazy looking people on the streets with like axes or something. But in the reality is the most violent forms of weapons and damage to others is done by men in suits in sterile rooms, who are coming up with things, and they come up with all sorts of justifications for creating a weapon that could potentially wipe out humanity. And that's what they did, and it's quite kind of remarkable. So those 2 movies are really, really good. There's 3 other movies I'd recommend, which probably aren't as well known. One is Babylon, which actually stars what's her name again? Margot Robbie. I forgot her name. She's in that. It's directed by Damien Chazelle, who did La La Land and Whiplash. A lot of people didn't like this movie. I liked it. It was a very fun, fantastical, fast-paced movie. It's about the Hollywood industry when you move from the silent era to the talkie era, when voice became. And it's just like a really fast-paced, super fun, energetic movie. So I like that a lot. Another one is Rye Lane, which is an English comedy rom-com based in Brixton. Just a really fun rom-com story, based around kind of a girl trying to get a record back from her ex-boyfriend and a guy helping her and stuff. Based in Brixton, a more realistic look of London rather than the Americanization of London, which kind of makes it look like something from the past. And then the other film I liked was Joyland, which is a Pakistani movie about a transgender person, which I thought was really, really good. Worth watching, and it gives you a nice kind of perspective of a city, Lahore in Pakistan, and then also gender dynamics. So that was really good. So that's on the film side. I probably watched more TV though this year, so let me rattle off a bunch of TV shows as well. So obviously something like Succession was amazing, but let me focus on some others that you may not be as familiar with. So one was Jury Duty, which is on Freevee, which is on Prime. And this is kind of a mockumentary thing where you had one person who thought he was a genuine juror in court, in an American court, and everybody else are actors. And they kind of wind him up and stuff like that. It's so funny. The other one's Hijack with Idris Elba, which is about a plane that gets hijacked, and Idris Elba has to kind of somehow kind of save it all. Really, really good. Silo, which was very good. Kind of a future dystopian sort of movie based on people living underground. Again, really, really good on Apple. Slow Horses, very good. It's kind of probably one of the best. Has Gary Oldman as a lead there. It's about a division of MI5, the Secret Service in the UK, which is kind of called Slough House, which is a bunch of losers, where the losers are, and somehow they get embroiled in kind of a certain case. And then the final one I'd say is a TV show called The Curse, which has Emma Stone in it. Again, a really clever TV show, a bit uncomfortable in parts. And it's kind of about like what happens when you have a super progressive kind of eco-friendly person moving into a small town in Arizona to kind of sort of live their values, and how it all like it's also artificial. And Emma Stone's fantastic in it all. So I'd recommend that as well. And then I did want to give a couple of shout outs to some anime as well, because I do watch a lot of anime. Three I'd mention. One is the Record of Ragnarok, which is an anime, and it's a really clever story, which is basically, in order for humanity to survive, they've got to win a series of battles with the gods. So you have round 1, round 2, round 3 of battles, and they're between famous humans versus famous gods from mythology. So you have like Zeus, the god, versus Adam, the first creation, Adam, fighting against each other. Or you have Hercules, the god of strength or whatever, against Jack the Ripper. Or you have Tesla against the god, or Buddha against the god. You have all of these sorts of characters. I mean, really clever and inventive. Demon Slayer, it's a classic. I actually only really watched it this year, but it's a fantastic sort of show about the slayer of demons. And then the other one, which I thought was quite interesting, is a Korean one called Lookism, which is, obviously Korea is very much, obsessed about looks and things, as are many other cultures, but Korea kind of really is focused on this. It's a show about a guy, kind of a dweeby, overweight guy who's super unpopular at school. Then mysteriously, when he goes home, he wakes up. He has another body that's a super good-looking, strong guy. And so that super good-looking, strong guy goes to school as that character, but his old body is sleeping. Whenever that character wakes up, the other body falls asleep, and so it's kind of a Dorian Gray, Oscar Wilde type story in some ways. So that's really good as well.
Cheers for that. No, that's a very decent selection for people, I'm sure, to binge over Christmas for sure. No, thank you so much for that, Bilal. It's been a really interesting conversation. Look forward to many more in the new year, and also just to sort of keep track of everything that MacroHive is doing in 2024 and all the sort of market moves that we'll be following through that. So thank you very much.
Great. No, thank you, Henry. And thanks. You've done fantastic work this year, Henry, first of all. Great job on this podcast as well as your other work. And for listeners, I mean, if people are interested in pop culture, reach out to me. If you're interested in the work we're doing on AI, want to learn more, do reach out to me. You can reach out to me on LinkedIn. And otherwise, just have a great sort of festive sort of period. And I hope everyone has a fantastic 2024.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.